Welcome back to the CFO's office. The mood in this room is different today. In the CEO's office, we talked about dreams. In the previous sessions, we talked about generating cash and growing wealth. Those were happy conversations. Today, the door is locked. The blinds are drawn. We are not here to talk about making money. We are here to talk about saving your life. In the world of professional fund management, there is a metric that scares managers more than any other. It is not low return. It is not high fees. It is called MDD, Maximum Drawdown. Maximum Drawdown is the measurement of the largest price drop from a peak to a trough. It is the worst-case scenario. If you bought at the exact top and sold at the exact bottom, how much would you have lost? Many investors ignore this. They only look at average annual return. They see a fund that returns 20% a year and say, "That looks great." But the CFO asks, what was the MDD? If that fund returned 20% but had an MDD of 70%, that means at one point, the fund lost nearly 3/4 of its value. Would you have held on? Or would you have panicked, sold everything, and realized that loss? Today, we are going to discuss managing MDD and loss defense strategies. We are going to look at the brutal mathematics of loss. Let's look at the numbers. They are terrifying, and they are non-negotiable. If you lose 10% of your capital, you need an 11% gain to get back to even. That is manageable. If you lose 20%, you need a 25% gain to recover. It's getting harder. If you lose 50%, you don't need a 50% gain. You need a 100% gain just to break even. Think about that. To recover from a 50% loss, you have to double your money. Do you know how hard it is to double your money? Warren Buffett averages about 20% a year. To recover from a 50% loss, you need to perform like Warren Buffett for 4 or 5 years straight, just to get back to where you started. And if you lose 90%? You need a 900% gain. That is mathematically impossible for most people. You are dead. This is why the CFO's primary job is not profit maximization. It is drawdown minimization. In U Incorporated, we play defense first. Offense sells tickets, but defense wins championships. So, how do we defend against MDD? How do we stop the bleeding before it becomes fatal? We implement 3 defense lines. Defense line number 1, the circuit breaker, the stop loss. In your house, you have circuit breakers. If too much electricity flows through, the breaker trips and cuts the power. Why? To prevent the house from burning down. Your portfolio needs a circuit breaker. We call this a stop loss. This can be a hard rule or a structural rule. A hard rule might be, if any individual stock falls 15% from my purchase price, I sell it. No questions asked. This sounds painful. You lock in a loss. But remember the math. A 15% loss is annoying. A 50% loss is a disaster. The stop loss prevents the annoyance from becoming a disaster. It removes your ego from the equation. You admit you were wrong, you take a small hit, and you live to fight another day. Defense line number 2, the cash fortress. We talked about cash flow earlier. But cash is also a defensive shield. When the market enters a recession and asset prices collapse, the correlation between assets often goes to 1. Stocks fall. Real estate falls. Corporate bonds fall. The only thing that does not fall in nominal value is cash. By maintaining a dedicated percentage of your portfolio in cash, let's say 10% or 20%, you artificially limit your MDD. If the market drops 50%, your cash drops 0%. Your overall portfolio drawdown is dampened. Cash is the airbag in your car. It doesn't make the car go faster, but it saves you when you hit a wall. Defense line number 3, the sleep test, volatility management. This is a psychological defense. Every asset has a beta, a measure of volatility. Bitcoin has high volatility. Utility stocks have low volatility. If you fill your portfolio with high volatility assets, you are guaranteeing a high MDD. You are signing up for a roller coaster. The CFO must ask the CEO, "Can you handle a 40% drop?" If the CEO says, "No, I would panic," then the CFO must forbid buying high volatility assets. You must design a portfolio that fits your emotional tolerance. If you cannot sleep at night because of your positions, you have already lost. You are over-leveraged or overexposed. The strategy is simple: cap the downside. If you can stop your losses at 10% or 15%, the winners will take care of themselves. You don't need to find the next Amazon to be rich. You just need to avoid being the guy who held Enron all the way to zero. Many people think risk management is boring. They think it limits their upside. They say, "If I sell at minus 15%, what if it goes back up?" It might. But You Incorporated is not in the business of hope. We are in the business of probability. The probability of recovering from a small loss is high. The probability of recovering from a catastrophe is near zero. We are building a dynasty here. Dynasties are not built on gambling, they are built on survival. So, look at your portfolio today. Do you have an exit plan for every single asset? If Apple drops tomorrow, do you know exactly at what price you will sell? Or are you just going to wait and see? Wait and see is not a strategy. It is paralysis. Define your MDD limit. Write it down. I will never allow this portfolio to drop more than X%. Then, build the defenses to ensure that promise is kept. Now, we have discussed how to stop losses using selling strategies and cash. But there is a more sophisticated way to manage risk. A way to build a structure that is naturally resistant to storms. It involves not putting all your eggs in one basket. In the next episode, we are going to discuss the holy grail of investing. We will talk about portfolio sizing and the art of asset allocation. We will learn how to mix stocks, bonds, gold, and cash to create a ship that cannot sink. The market is a dangerous ocean. Keep your life jacket on. I'll see you in the next video.